Hi everyone, this is a short screencast for Independent Colleges Dublin covering F6 taxation and the May 15 mock exam. In this particular screencast we're going to be covering question 2, which is the CT or corporation tax question, and it's a fairly straightforward question, certainly in its format, in terms of being an adjustments to profits for a limited company and also a CT comp. So let me take you through the question first and then the answer. Fairly normal setup here. What we're given is a trading and profit and loss account with a variety of different notes relating to expenses. The company is Bracken Limited, and really the first thing that I would be looking for when I scan this down is where my starting point is going to be. And unusually here what you'll see is that their starting point is a net loss rather than net profit. So just watch for that, and also watch for them perhaps including maybe a dividend payable or some sort of appropriation figure. I mean, we're looking really for net profit or net loss before taxation and indeed anything else. So our starting point is this 102, and really what we've got to do is just run down the expenses and indeed any other income and see what we add back and what we deduct. Okay. Now in terms of the notes, I won't go through each one, but certainly you'll see that within the F6 taxation syllabus in the exam, there are only a certain number of tricks or adjustments that the examiner has to play with, and you'll see within this question he plays with some of the more common ones and then just one or two slightly more obscure ones. I think the thing to do is just really make a list of the types of things that you expect to see in the exam and just make sure that you can deal with them quickly. Do bear in mind, as I say in classes, that you have a 50-50 chance, and the key is to get to an adjusted trading figure as quickly as you can, not necessarily that it's 100% correct. So do bear that in mind when you're doing these questions. Don't dwell on any one expense. Just get down to the bottom of that page where the adjusted profit figure is and get to there quickly. Okay. So if we take it that the net losses are a starting point, and we'll come to the answer, we'll see that they've started there, of course. In terms of the notes that are of relevance here, note 2 is one that you would expect to see. In other words, dividends being received by the individual company. The first one here is from an Irish company, and there's some easy marks there. We'll see within the answer that that's pretty easily dealt with. So we've got a dividend coming from an Irish company to an Irish company of 20k. I want to just figure out what we do with that. They also play the foreign dividend trick, and notice that the shareholding is less than 5%. Now if it is less than 5%, what do? Well, we tax that at 12.5% and not the normal 25% rate. In addition to that, we have some deposit interest. We should be aware that investment income for a company in the main is going to be taxed at 25. So again, they're always going to play a trick in the area of rates, so just watch out in particular for dividends. Notes 3 and 4 relate to charges, the first one being a trade charge, in other words a charge paid out for trading purposes, and we should be aware that that is actually deducted on a paid basis. So you'll see in relation to the entries above that there's a 30k entry in the P&L account. We've got to add that back and then take out in the CT comp from case 1 income this £20,000 paid figure. We should also note here that royalties are paid net of 20% income tax, and you'll see within the comp that there is an additional item payable by the company of 20% times 20,000 in income tax because of really IT that they will have deducted before they paid out those royalties. So more of that later. In terms of this area of interest, obviously bank interest must be normal, a normal trading expense. We've got a couple of items here. I think there's an error in the answer in terms of these items. These for me are both what we call non-trade charges, and in effect then they also have to be included in our add backs, but deducted within the CT comp against non-trade income. So more of that later. Just watch for the error that I believe is in there. Next point is in relation to pensions, something that I would invariably expect to see within an adjustments to profit computation. In this particular case, we have 20k prepaid, and we'll see in the comp how that's dealt with. Motor expenses, more often than not, there's quite a few items that they'll put in that are allowable. I mean, I always err on the side of allowability unless there's something very, very obvious. In this particular case, that bad phrase, car lease, there's lots of tricks in relation to cars being leased. It looks to me as if the other items, staff using their own cars in a running cost for the MD and the cars owned by the company, I think they're perfectly fine to leave where they are. It's this figure here of 11 that we're going to have to adjust based on the fact that it's a lease and a Cat D car of 30k. More of that later. In terms of the subscriptions, the only thing that I can see that's a little bit unusual here is just this political subscription. In fact, the other one's trade, registered charity, and the social fund. I expect them to be okay. Cap allowances, I'll always expect quite a lot of information within the CT question on cap allowances. And just remember, we're trying to make up our cost box, as it were. It's done in a sort of a vertical format in the answer. I'm inclined to use that horizontal format, to be honest with you. I think it's easier to work with. In terms of what we have here, as you would expect within a CA comp, we're going to have cars and a variety of different categories, and we've really just got to see, what do we strip out for disposals, what cost, and what do we put in for additions. There's always some sort of trick where we're not including the normal cost or the cost that you would expect. We're including perhaps 24k or taking out 24k, so more of that in a moment. In addition, with the disposals, this area where we're having to either uplift or restrict the proceeds based on the fact that when the car was ingoing, it was ingoing at a different price to what it was actually purchased for. So we'll see how that works within the question. And indeed the answer. 2 parts, as you would expect, adjustments and then a CT comp. We're looking for easy marks here. We're not looking for problems. We're looking for solutions. So, these types of questions, I think there is 15 marks here. Probably, 3 or 4, maybe even more, will just be very, very basic marks. And note that we only need 7.5 to pass this. So do look for the easy marks. You see something difficult, just try and make a decision on it, put it in, and then move on. Don't get sucked in by the examiner. That's what he's trying to do to stop you moving forward. Okay. Now, in terms of the answer itself, as I've said, we must start correctly. So it is net loss per the accounts, and notice how that sort of, I guess, reverses your entries because you're starting with a loss. So you've really got to make sure that you work with your pluses and your minuses correctly. I'll just scan down some of these. As I say, I think there's 1 or 2 areas within this answer. I'll try to make them clear to you. Obviously the obvious ones like depreciation, and indeed if it were in this question, which is not client entertaining, I'd start with them first and pick up a half a mark each. The royalties, as I've said, this is the figure shown within the trading and profit and loss account. We're effectively adding that back. We're getting rid of that and we're taking it to the CT comp. So just watch out for trade patent royalties. We're looking to add back and then bring them to the CT comp. These 2 items here, for me, they are interest for non-trade purposes. So for me, that they are non-trade charges, and we'll see when we look in the comp in part B that they should be deducted from non-trade income. In terms of this motor lease, as I mentioned earlier on, it's a Cat D car. So what we've got to do is use our little fraction based on the value of the car, which is the 30 less the 12 divided by the 30. So it's difficult to remember these little fractions, but just practice makes perfect. And in effect, what we're saying is that there's an amount to be stripped out of the 11,000 based on that formula because it's a Cat D car. So 30 less 12 divided by 30. The political subscriptions are going to come out. As we know, the other ones stay in. All of the subscriptions stay in. In terms of the deductions, always, and 100% of the time, the other income is going to come out. So let's get those half marks for doing that. In this case, the pension unusually is a prepayment, so not relevant for this period. That's also got to come out. And then we get down to our adjusted trading figure before CAs. In terms of the CAs, as I said, I tend to work horizontally rather than vertically. Perhaps this is a little bit quicker, but I tend to think that it's easier not to make mistakes when you're working across the page. You may think differently. And really, all that we're doing here is really populating our box. We're trying to get down to this closing cost figure. I've said bingo here just to remind you that, one way or another in the exam, let's get to this figure. And what do we do when we get there? Well, we just slap on our 12.5%. So, even if we get one or two of these figures wrong, we'll still get that half mark for showing the marker. We appreciate that the cap allowance figure is based on the closing stock, the items in use at the end of the period. Now, in terms of the numbers here, I'm not going to go through the detail because this is very much sort of a rote learning area, and some of the information you'll pick up from your tables. Really, we start with our opening cost, and all of these figures are cost figures. None of them are tax written down values. None of them are disposal proceeds. They're all costs. So let's just try and exclude, for example, the original cost that was included for this Cat A car that is disposed of. It went in at 24. Therefore, let's take it out at 24. In terms of the Cat B, the Ford, the addition, it has to go in at 24 because it's a Cat B car. Vans, often play that little trick. We're not going to adjust in any way for that. They might even give you a category for it or an emissions. It's not relevant. It goes in at normal full cost. And then Cat E, as I've said, is going to be based on that information within your tables. In this particular case, I think it's 50% of 22. So we have several items there. Tables are very helpful in that area. This gives us the 17 figure here for, excuse me, for wear and tear allowance. In terms of this balancing allowance, just remember that we're comparing proceeds, or indeed adjusted proceeds, to tax written down value. What we've got to do here is really scale down the proceeds because of the fact that the car was restricted ingoing. I'll explain this little 3/8 in a moment, but in essence what they're doing is comparing the restricted proceeds to the tax written down value, and the difference is 1320. Now, just a note on that that 3/8 figure that is here. Basically what we had is a car that had, in effect, an 8-year life, because if we're depreciating it or allowing CAs at 12%, 12.5% over 8 years, that's effectively 100%. So if 5 of the years have gone, that means 3 of the years are left. So what they're doing is they're saying, if this is the value that's ingoing, if you depreciated 5 years worth, then you have 3/8 or 3 years over 8 years left of the tax written down value. Okay, so that's where that 3/8 comes from. Okay, so we really get to the case 1 figure here of 147280 based on what I've said above. Okay, in terms of the nuts and bolts, particularly in relation to the CAs, you'll see that a variety of information for you here on really how we pick up those figures, how we adjust the proceeds, for example, 24 over 25 times 8, and indeed the ingoings and outgoings in relation to the cost or the cost pool, as it were. Okay, so that's part 1 or part A. In terms of the CT comp, we know that we have the figure from above, that's the 147, so no marks there for that. And you'll notice here that we have trade charges and non-trade charges. You'll remember above in the adjustments, we took out the figures shown within the trading and profit and loss account of 30. In other words, we added that back, and we're including trade charges in the CT comp based on the paid amount, and that was given in the question. So all we're having to do is just take off that 20,000 In terms of this figure here, we have the UK dividend interest of 11 and the deposit interest giving us the 16, and indeed the rental income, which I believe is detailed lower down. In terms of the non-trade charges, I think that this should actually include the 3,000 for the quoted shares rather than being 15. And the other point here is that this figure, which should have been 15, would be deducted from non-trade income in effect. And what they haven't done here, they haven't equated the values that they're taxing with the taxable profits. So you'll see that it's sort of 12,000 euros according to their figures, light in terms of, sorry, over in terms of an adjustment. So just note that this figure here should have been taken off the investment income. In fact, it wasn't, but I think that it should be 15,000 anyway and not 12. You'll see in the question that there's interest on the quoted shares. Okay, so we're just applying the rates. Watch this area here of the CT comp. Particularly when you have, say, non-trade charges, if they had been used, it's easy to make a mistake on the rates. Okay, we note that the UK dividend interest has been taxed at 12.5. Remember, it's less than 5%, so that has to be 12.5 rather than 25. And obviously, note my comment about the non-trade charges, which should have been a deduction in my view. Here's the income tax that was deducted at source. So when they paid out the royalties to the company, they held back 20%. So in effect, the revenue is saying, well, you're an unpaid collector of taxes. We now want that figure. We want the 4,000 that you have in your pocket. Note also that in relation to the dividend from the Irish resident company, they've made a point of saying that that is exempt. Get a half a mark just for that. Don't forget to do that, even if you know the answer. That's marks for very little. Okay, I've mentioned here just this point number 7. That it's not actually done. This non-trade charges haven't been deducted. I'm not sure what the workings here are. I don't think these relate to the question in any way, so no need to dwell on those at all. A couple of notes here in relation to the rates that you're going to be applying, as shown above and as I've explained. So hopefully that is of some help for you and that makes sense, and thanks for listening and good luck with your studies.